Hey, good morning, everyone. Marty Mazzora here, the 2nd of March, 2022, Wednesday. About an hour and a half left in the trading session, seeing a real nice bounce in equities today globally. And talk about that, talk about what I think is happening here today. But the purpose of these videos is to really take you through the charts and consider what the technicals are telling us about present market conditions. So like we did time before last, we'll take a look at the S&P, the NASDAQ composite, we'll look at ag futures via our ETF, metals, gold, and silver. So consider this an update from that video I did about a week ago. And I'll talk a little bit about what I talked about then, what's happened since, and so forth as we look at each chart. In terms of this morning, Fed Chairman Powell has two-day mandatory testimony that he does every now and again in front of Congress, and he has been, as adept as any Fed chair ever at helping the stock market along on the days he's speaking. Right off the bat this morning, voting member of the FOMC, Federal Open Market Committee, James Bullard, who's been pretty hawkish of late, said we need to get off the dime and we need to go at inflation, essentially, more eloquently than I just said that. And then Fed Chair Powell, essentially, as I suggested in the morning note, that the market was going to be very interested in, is it 25 basis points, 0.25%, or 50 basis points, 0.5%. And I suggested that if it's, if he gives a strong hint that it's 0.25%, market's probably going to rally. So I think that pretty much explains why the S&P is up a bunch, and so is the Dow. And the NASDAQ is doing okay as well. Very okay, in fact, on that news. Also, earlier in the morning, there was news from the Russian negotiator when they get back with Ukraine to continue their talks, who said, ceasefire is on the table. And I think that had something to do early on. Since then, and I'm just reading through the headlines, heavy shelling has continued in the capital of Ukraine. So that kind of quells that anticipation that maybe there'll be some ceasefire. But the fact that the person mentioned it would be very bullish on an immediate term basis. So our short-term thesis would be a ceasefire, would be extremely bullish for global equities, bearish for commodities, until we wake up and realize that to the extent that that situation in Russia and Ukraine provided a reason for central banks to maybe wait and see a little bit and maybe not be as aggressive in terms of fighting inflation, well, then that would be off the table. And then the market would have to contend with that. So indeed, you could see the market short-term just roll right back over to some extent. But if we're looking for reasons for the central banks to back off a little bit, we are seeing generally slowing macro conditions. And certainly here in the U.S., and we're seeing it broadly as well. Now, if you listen to Chairman Powell talk, the U.S. economy is in incredibly good shape. But that's not necessarily what our observations are, at least at the moment. But we don't see recession coming anytime soon. I talked about that on the macro video here this last weekend. But you could argue that growth rates are slowing, therefore the Fed doesn't have to be as aggressive. However, inflation will calm down to some extent, but maybe not to the extent people are hoping. And then you have that situation where you have a slowing economy, but you have debilitating inflation, and that sums to stagflation, and that's a very ugly scenario as well. So, folks, there's just a myriad of headwinds facing the markets, particularly the U.S. equity market, in our view. Midterm elections are coming, and is there going to be the Biden spending plan passed? If there is, what does that do ultimately in terms of the inflation needle, right? And if there isn't, how does the market respond to what essentially is fiscal tightening and so on? So it's almost dizzying when you look at all the factors that the market has in front of it. Now, technical analysis is designed just to kind of take all of that out of play and just say, what are the charts telling us? The charts are going to reflect fundamental reality, is the theory behind technical analysis. We like doing it. We think it's important, but we want to look at both. We want to do the technical analysis. We want to do the fundamental analysis. And we want to put those two things together. And as I've said before, the technicals really help us a lot in terms of, entry when new cash comes in, rebalancing, hedging, and so on. So anyway, without further ado, you have the daily S&P 500 chart on your screen. Recall that I'd made a big deal out of the support line right here and how the S&P 500 crashed right through it, opened down here, but then quickly recaptured it, and boom, 2, 3, 4 days into recapturing it, and you can see right here on a couple of days it held as really nice support. So it really didn't come back and act as really any resistance, save for the that next day is where it closed right below the line. So here we are battling it. As I suggested here, we've got some upside resistance to contend with. We have this pretty well-defined downtrend line, right? We have several hits. That's how you define that. So that's what the market is run up against here, and you can see it's running up against there as I speak. And then you've got the 200-day moving average, and you have a descending 50-day moving average, and then you have these other resistance levels. So again, absolutely unequivocally, perhaps a ceasefire, right? At least initially. Could see this thing just bounding right through. Plus, on the daily chart at least, you've got a pretty good looking setup, right? You've got, really you have a downward sloping wedge, which is bullish to me when you have these bullish divergences, right? You have a lower low, but you have higher lows, and now you're getting a buy signal on the moving average convergence divergence. So those are really good short-term technical signs. So that suggests that, again, the market is beginning to expect that indeed we're going to break through, at least here, and test this 200-day moving average. So the daily chart says that there may be, right, maybe some oomph left in this rally that we're seeing right here. Now, when we think about longer term, which is really what we're all about when we're managing other people's money, and we look at the weekly chart, well, not so much. Okay, so this is your 50-week moving average. This is your 200-week moving average. And so we broke through this upward sloping bearish wedge with momentum, not a good sign, came back, crashed through this, this what could have been support. And don't seem to be able to penetrate that on a weekly basis. Closed last week below the 50-week moving average and pushing up against that right here. Okay, so again, there's some hope here for sure. But then when we look at the momentum indicators, we don't have what would be a bullish look here by any stretch. So remains a concerning, somewhat bearish looking weekly chart. And then when we zoom out to the monthly, probably even worse looking, frankly, than the weekly chart. So we broke out of this upward wedge, another down month. So each candle is a month. So there's your January candle, there's your February candle, and here's your March candle so far. Doing its best to try to recapture some levels here. What is most concerning would be this look right here on the monthly moving average convergence divergence, right? So that's a sell signal where the white line drops below, and when we have quite the gap and it comes through with force, that suggests that there's some downside momentum here. And when we've had these sell signals before, we tend to get pretty decent corrections. This was 35% here, this was almost 20%, this was 16%. And when you go further back, you just don't have a good time immediately following a sell signal on the monthly MACD. Now, could we turn right back up? Sure. It's when you come down, and you have some gap, and it looks like you're really sloping down with momentum. That could suggest that you're getting some people really distributing away from the market, and maybe there's some more fear coming. None of this has to play out. History does not always repeat itself, particularly when we've got global angst that could go away in a hurry, or maybe Federal Reserve, I think, is a real headwind, but who knows? Who knows what their policy is going to be when we're sitting here, 6 months to a year from now. That NASDAQ composite, if you'll recall in the last video, I had created this chart over the weekend, and what I show is these long-term, weekly moving averages, the 50-week and the 200-week moving averages. And I zoomed back out here to, I think it was 1995. And I showed you that literally without exception, when we break through the 50-week moving average with momentum and it begins to roll over, like here, like here, here they were just kind of stuck together. Here we did roll over. Here, again, here where the 50 was above, here, here, and here on the NASDAQ, right? We had declines of 33%, 78%, 14%, 15%, 56%, 19%, 20%, 20%, 24%, and 33%. And but without exception, when we broke through, and we had this kind of look, we had a rolling over 50-week moving average, breaking through, and then retesting and failing it. We came down, and we did indeed test the 200-week moving average. If we end up in bear market conditions and we crash through that, then we have something even more meaningful to the downside. What we also have here, and I didn't necessarily see this last time, but you do indeed have a bear flag pattern here on the weekly. That's one that's pretty classic. So you had the bear flag pattern. You broke through to the downside. Now the price target, if you're a technician, would be the length of this flagpole, which ironically would take you really close to this 200-week moving average. So you have this history of what tends to happen when you break through there. And now you have a pattern that even adds more, of a probability to that. Again, I don't know that this is going to happen. I'm a little skeptical, frankly, based on the potential for something positive to come out of Europe and push markets back higher. But remember, when we're talking about the NASDAQ, we're talking about something that's very tech stock heavy. And tech stocks are the ones most at risk to rising interest rates and inflation. They're what we call the longest duration stocks. They're the ones that are most sensitive. So if a ease up in the European pressures just basically creates more confidence that the central bank can go after inflation, then tech is probably going to be your worst performing sector, frankly. And then when we go to the daily, however, we have that bullish look that we had in the with the S&P, right? We have, your falling wedge that we've broken out of right here, right? We have very bullish divergences on the momentum indicators. So this is bullish on a short-term basis, except for the fact that indeed, if you can see this, let me clean that up. Start over here. Even on the daily here, you can draw a pretty good bear flag. And as technical patterns go, these can be pretty reliable. So you have a pretty good sell-off, you have the consolidation of those losses, and then you resume. And that would take us right about here to this 12,000 resistance level. But again, that's there, but these are there as well. And these have been pretty reliable trading patterns for us in the past. So again, folks, so when we zoom out on a long-term basis, the go-forward prospects for the U.S. market are concerning from a technical perspective. Okay, so we looked last week at our ag commodities position, which has been very good to us. We bought it right back here in September of 2020, and it's up over 50%. But I said we were looking at somewhat of a consolidation pattern right in here. This big pop, of course, is all about the ag commodities that come out of the Russia, Ukraine area of the world. And you can see that this can be volatile stuff. But then we popped back, and now we're fighting again with this level right here. We'll see how that plays out. Definitely commodities are feeling it today. That's this blue candle. That's a down candle. Got our long-term trend line. We've got really positive looking action in both the 50 and the 200-day moving averages. Take a quick look at our other futures ETF, base metals, DBB. Bought this at the same time in September of 2020. And again, remember we said we had this symmetrical triangle consolidation pattern. Kaboom, really bounced out of that with some force. It's the commodity area that we're in. It's actually up on the day so far today. So we've got these big, bounding gaps higher. Gaps tend to get filled, so of course we'll see some give back here. Nice fresh buy signal right here on the MACD, but overbought on the RSI. But these are all positive looking setups from a momentum indicator. And this is about to, if this overcomes that line there, then suddenly anything that you might say is bearish about this goes away. So again, long term, love the space, copper in particular. But yes, there will be absolutely corrections, but this is a nice technical setup, at least on the daily chart. And then gold, and then we'll talk about silver, and I'll let you go. So remember here, we looked at gold, looked at how well it's been performing, pointed to this resistance, said we could run into something here, shot above it, lost it that very same day, couldn't keep it that day. Then we had a big update. A lot of this is on the Russia-Ukraine news, of course. Selling off a little bit today, although off its lows. This is the high and low of the daily candle, and this is where it's been. This is the wicks or the shadows of the candle. So today it's found support right on that support line. We'll see if that holds. Don't know that I'd be all that bullish on gold right here, particularly if things, as we certainly hope and pray, calm down in Europe, and then you get the Fed back on the table. Long term, we don't believe there's a whole lot of upside that the Fed can accomplish with interest rates. We're structurally bullish inflation. It's probably the best long-term setup for gold that you can imagine. But along the way, there's going to be a lot of volatility, and we did just roll our hedge a little closer to the money this week too, so we have a little better downside protection than we had previously. And then recall with silver, I said we're earlier kind of in the uptrend, but I did say this was a nice shorting op right in here. In silver, we had our retracement at 50%. We had this resistance line. I'd suggested that very highly likely that wasn't going to hold. And if I were a short-term trader of silver, I would short it right here. Boy, would that have worked nicely, but it found support right on that 200-day moving average, just like a charm. And it's sloping in the right direction. And if the 50 overtakes that, to some people, that's a real bullish crossing sign there or signal there with these two moving averages. So, but, came bouncing right back. And again, silver has been very bullish on the Ukraine news. So as you might imagine, folks, our positions in things like gold, silver, and ag pretty much offset certainly the lion's share of the pain that our portfolios felt as stocks were careening off and on so far this year, particularly around this Russia-Ukraine situation. So they've been kind of doing their job, right, as hedges, in addition to the put hedges that we have on. So very constructive on silver long term. Short term, we'll see. It's going to be volatile for sure, particularly on news out of Europe. And, still a really good look here. Very bullish, buy signal here on the MACD. Little overbought here on the RSI. Seeing that retracement here reminded me, I looked at this earlier and forgot to mention it. On the daily S&P chart, there is another level of meaningful resistance from a technical perspective. When we run a Fibonacci retracement, you go to the high here of the recent top, and then the recent bottom, and then you begin to retrace. And remember, it's the 38.2, the 50, and the 61.8 that are the most meaningful. And we're running into that 38.2 and our downtrend line, both at the same time. And you can see the bulls and the bears also doing battle right here when we look back, to say last July, right? Resistance, support, 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 some resistance, support, came down. So we're right on this line right here. Wow. So we've got the 38.2 retracement, which is very meaningful technically. You've got this resistance line at the moment. You have this downtrend line. You have the 200 and the 50-day moving average above. These are serious technical headwinds, but I'll tell you, lastly, and then I'll be quiet, there's the potential for some really good news. Hopefully. I mean, there's really bad news going on, so that bad news turns into good news, and you could see a nice rocket higher. But then we're going to be talking about a hawkish Fed. So, folks, lots to think about, lots to parse, technically, but most importantly, fundamentally, going forward. It's going to be a very interesting, challenging year, pretty much across the board. Lots of stuff we like out there longer term, but definitely need to be tactical, we think, and play some defense while we're looking for those opportunities. Folks, thank you as always for watching and listening. Talk to you again soon. Bye-bye.